Hey everyone, welcome back. Today is Friday, January 16th, 2026. And as we do at the end of every week, I'm bringing you a detailed analysis. I'll be sharing my latest research on this company. In return, I just ask you to be fair with me. So if you find my analysis helpful, please consider liking the video. All right, so we're trading at 26.44 as of yesterday's close. And I've got to tell you, after spending the last 48 hours digging through institutional filings, dissecting the Q3 earnings transcript, and running my valuation models, there's a lot more happening beneath the surface than what you're seeing in the headline price action. In my daily work as an equity research analyst, I focus on identifying inflection points before the market fully prices them in. That's what separates institutional grade analysis from retail sentiment chasing. And right now, this name is sitting at one of those inflection points. Let me explain what I'm seeing in the data, what the smart money is doing, and why the next 14 days before earnings on January 30th are going to be critical for anyone holding or considering a position. So first, let's talk about where we are today. The stock closed at 26.44, down about 1% from the day before, and we're sitting roughly 19% below the 32.73 peak we hit back in early December. Now, in my experience, when a growth stock retraces 20% from its highs while fundamentals continue strengthening, that's usually noise, not signal. The market is digesting the $1.5 billion equity raise that closed in early December. There's some year-end tax loss harvesting happening, and frankly, a lot of retail momentum traders who bought in the high 20s are getting shaken out before earnings. This is textbook pre-earnings consolidation. Looking at the technical setup, we're trading in a range between 26.61 and 27.55 over the past few sessions. Volume has been elevated but not panicked. The 52-week range is 860 to 32.73, which tells you everything about the volatility profile here. This is a stock that moved 280% from trough to peak in less than 9 months. If you can't handle 15-20% drawbacks, you shouldn't be in growth names, period. But if you understand how to size positions appropriately and use options to manage risk, this volatility is exactly what creates alpha. Now let me get into the institutional activity, because this is where my analysis really focuses. In my view, the single most important leading indicator for any stock is what large institutions are doing with their capital. Retail can move stocks 5 to 10% on momentum, but institutions move stocks 50-100% over quarters and years. And what I'm seeing in the latest 13F filings is absolutely fascinating. Rakuten Securities increased their position by 137.2% in Q3, now holding 866 out of 496 shares worth approximately $22.9 million, representing 8.4% of their entire portfolio and making this their third largest position. When a sophisticated Japanese financial conglomerate with operations across banking, fintech, and e-commerce makes a name their third largest holding, I pay attention. But it's not just Rakuten. SJS Investment Consulting boosted their holdings by 840.3% in Q3. Let me repeat that because it's not a typo. 840%. These aren't 10% trims or 5% additions. These are massive conviction-based accumulation moves. Total institutional ownership now sits at 57.2% according to the most recent data, with Vanguard holding 9.71%, BlackRock at 5.66%, and significant positions across hundreds of other funds. What this tells me in my analysis is that the smart money is positioning ahead of earnings, not reacting to them. They're buying the uncertainty and the volatility, which is exactly what you should do if you believe in the fundamental story. From my perspective as someone who builds financial models for a living, the institutional accumulation pattern here mirrors what I saw in names like Shopify in 2019 and Block in 2020 before their major multi-year runs. Not saying this will replicate those, but the setup is similar. Growing revenue at 30-40%, expanding margins, diversifying revenue streams, and institutions quietly building positions before the broader market realizes what's happening. Let me talk about what happened on January 15th because this is important context. The company announced monthly distributions on the SoFi Enhanced Yield ETF, ticker THTA, offering a 12% distribution rate and paying $0.252 per share monthly. Now, some people are asking me, why does an ETF launch matter for the stock? And I'll tell you exactly why this matters from an institutional investor's perspective. This company is building out asset management capabilities, which is one of the highest margin, most capital efficient businesses in finance. If they can successfully launch 5 to 10 ETFs over the next 24 months and gather $3 to $5 billion in assets under management, that's $25-40 million in annual recurring revenue at almost zero marginal cost. That flows straight to EBITDA at something like 70-80% incremental margins. In my models, I'm not even giving them much credit for this yet because it's early stage. But strategically, this is exactly what separates a lender from a financial ecosystem. Banks lend money, take credit risk, and operate with 15 to 20% ROE. Platforms aggregate multiple revenue streams across lending, payments, investing, and asset management, operate with 25 to 35% ROE, and trade at 3 to 5x price to sales instead of 1.52x. The market will eventually re-rate this as a platform, not a bank. We're just in the early innings of that re-rating. Now, let me address the valuation question head on because this is what I get asked about most. The stock trades at a forward price to earnings ratio of 46 to 48 depending on which estimates you use. The S&P 500 trades at 22. On a surface level, you could argue this is expensive, and in fact, several sell-side analysts have made exactly that argument. Goldman Sachs cut their target from $27 to $24, citing valuation. Bank of America resumed with an underperform rating after the capital raise. So there's clearly some skepticism out there. But here's how I think about valuation in my work. I don't compare this to JP Morgan or Bank of America because those are mature, slow growth financials. I compare it to PayPal, Block, Upstart, and Affirm. PayPal trades around 11x forward earnings but growing at 8 to 10%. Block trades around 27x forward earnings growing at 15-20%. This company is growing revenue at 36 to 38% and earnings at 57% in 2026 according to consensus estimates. If you believe those numbers, then paying 46x forward earnings for 57% EPS growth next year and 25-30% compounded growth for the next 3 years is actually reasonable. That's a PEG ratio under 1.0, which by any metric is attractive for a high growth fintech with a bank charter. The key ratio that big institutions use to evaluate these situations is what I call the rule of 40. You take revenue growth percentage plus EBITDA margin percentage, and if it's above 40%, the company is in the efficiency zone where it can grow fast while staying profitable. In Q3, this company reported 38% revenue growth plus 29% EBITDA margin, which equals 67%. That's not just above 40%, that's in the elite category. In my experience covering fintech for years, any company consistently posting rule of 40 scores above 60% deserves a premium multiple period. Let me walk you through what I'm seeing in the Q3 results because this is critical for understanding the earnings setup on January 30th. Revenue came in at $949.6 million, up 38% year over year, beating estimates. Adjusted EBITDA hit $277 million at a 29% margin, up 49% year over year. Net income was $139 million with a 14% margin, translating to 0.11 EPS, which beat the 0.08 consensus. Members grew 35% to 12.6 million, with a record 905,000 net adds in the quarter. Products grew 36% to 18.6 million, adding 1.4 million in Q3. The cross-buy rate reached 40%, meaning 40% of members are using multiple products. Now, here's what I focus on in my analysis. The financial services and technology platform segments generated $534 million in revenue, up 57% year over year, now representing 56% of total revenue. This is the key metric I'm watching because it shows the business is diversifying away from lending toward higher margin capital light revenue. In my models, I'm projecting this segment to reach 65% of total revenue by end of 2026, which would support significant multiple expansion. The lending segment still grew 23% to $481 million with record originations of $9.9 billion. Charge-off rates remain around 2.6%, well below the 11% credit card delinquency rate we're seeing industry-wide. And this is critical because some bears are pointing to macro credit concerns. But when your average borrower has a 745 FICO score and $157,000 annual income, you're not taking subprime risk. You're lending to prime borrowers who traditional banks are now turning away as they tighten standards. For Q4, Wall Street expects revenue around $981 million, an EPS of 0.11 to 0.12. Management guided to full year 2025 adjusted net revenue of approximately $3,375 billion, up 30% year over year, adjusted EBITDA of $960 million at 28% margin, and adjusted net income of $455 million with EPS of 0.37. If Q4 comes in at the high end of that range, we could see revenue exceed $1 billion for the first time, which would be a major psychological milestone. In my models, I'm running three scenarios for 2026. Bear case assumes 20% revenue growth, 26% EBITDA margins, some margin compression from increased marketing spend, and we end the year around $4.05 billion revenue with 0.50 EPS. That gets you a fair value around 23 to 24 at 46 to 48x forward earnings. Base case assumes 25% revenue growth, 28% EBITDA margins, continued member growth above 25%, and we end 2026 around $4.22 billion revenue with 0.58 EPS as consensus expects. That gets you fair value around 29 to 31 at the same multiple. Bull case assumes 30% revenue growth driven by crypto adoption, ETF success, and accelerating technology platform revenue, 30% EBITDA margins, and we end 2026 around $439 billion with 0.65, 0.68 ons EPS. That supports 34.38 odd fair value. The way I'm positioned personally, I think base case is most likely, with bull case possible if execution continues at the pace we saw in Q2 and Q3. The $1.5 billion capital raise gives them dry powder to accelerate growth, pay down higher cost debt, and potentially make strategic acquisitions in blockchain or AI applications. That's what Needham's analyst highlighted in his note, and I agree with that assessment. Now let me talk about the upcoming catalysts, because this is what drives trading over the next 90 days in my view. The first and most obvious catalyst is Q4 earnings on January 30th. If they beat on revenue, guide Q1 and full year 2026 above consensus, and show member growth staying above 30%, I think the stock moves back to 31 to 33s within 48 hours. Options market is pricing in about a 10% move in either direction, which seems right to me given historical volatility around earnings. The second catalyst is potential S&P 500 inclusion in Q1 or Q2 2026. To be eligible, you need $18 billion market cap, which they have at $33 billion, and 4 consecutive quarters of GAAP profitability, which they now have. Inclusion would force passive index funds to buy tens of millions of shares, creating a massive liquidity tailwind. This is not priced in yet, in my opinion, and when you see companies get added to the S&P 500, you typically get a 10 to 15% pop on announcement and another 5 to 10% into the effective date as funds buy. The third catalyst is crypto adoption. They relaunched crypto trading in Q4 and issued SoFi USD, the first stablecoin from a US national bank. If crypto penetration reaches 25 to 30% of their 12.6 million members, that's 3-4 million active crypto users. Even at $50-$100 revenue per user annually, That's 150, 400 million incremental revenue opportunity at very high margins. I'm not modeling this aggressively yet, but it's real upside optionality. The fourth catalyst is the technology platform business, which is the most underappreciated part of this story. In Q3, CEO Anthony Noto highlighted that loan platform partners came back in Q4 asking to upsize their commitments, not reduce them. The business has grown 4x with $3.4 billion in originations. If this scales to 10 to 15 billion over the next 18 months, that's another $200-300 million annual revenue at 40-50% margins. This is infrastructure as a service for financial institutions, and it's a massive TAM. Let me talk about risks because I always balance my bull case with what could go wrong. The biggest risk is if member growth decelerates below 20% year over year. That would signal saturation or increased competition, and the stock would likely derate to 30-35x forward earnings, putting fair value around 20 to 22. The second risk is credit deterioration. If charge-offs move from 2.6% to 4 to 5% due to macro weakness, that would pressure net interest margins and profitability. Third risk is regulatory. They operate under a national bank charter, and any regulatory changes around capital requirements or crypto activities could impact the business model. Fourth risk is dilution. They just raised $1.5 billion by issuing 54.5 million shares at $27.50, creating about 4% dilution. If they come back in 12 months and do another raise, that would frustrate shareholders. The valuation risk is real too. At 46 to 48x forward earnings, there's not much room for error. If growth slows or margins compress, the multiple will contract quickly. In downside scenarios, I could see the stock trading back to 30-35x forward earnings, which on 0.58 2026 EPS would put fair value around $17 to $20. That's a 30% downside from current levels, which is why position sizing is critical. Now let me talk about how I'd play this with options, because in my daily work, I use options extensively to manage risk and enhance returns. If you're bullish heading into earnings, I'd look at a February bull call spread, buy the $26 call and sell the $31 call, both expiring February 21st after earnings. The net cost is probably around $230, $260, so $230, $260 total. Your max profit is $270, $240 if the stock is at $31 or above at expiration, which is about 90-105% return. Your max loss is limited to the premium paid. This gives you leveraged upside with defined risk. If you own shares selling covered calls at the $30 strike expiring January 31st could make sense. You'd collect roughly $1.40, $1.80 in premium, which is 5 to 7% income in 2 weeks. If the stock stays below $30, you keep the shares and the premium. If it goes above $30, you sell at $30 plus keep the premium, which is still a nice return from $26.44. If you're waiting for a better entry, selling cash secured puts at the $24 strike expiring February 21st let you collect $1.62 premium while committing to buy shares at $24 if assigned. Your effective cost basis would be 22 to 22.40, which is a great entry point in my view. If the stock stays above $24, you keep the premium, which is 7 to 8% return on collateral. For more sophisticated traders, a short straddle or iron condor might work if you think the stock stays range-bound between $25 to $28 through earnings. But that's higher risk and requires active management, so I only recommend that for experienced options traders. My personal stance as an analyst is that this represents compelling risk-reward at current levels for a 12-18 month hold. I'm rating this a buy with a $33 price target for year-end 2026, which implies 25% upside from $26.44. That target assumes they execute on Q4 earnings, member growth stays above 25%, EBITDA margins stay at 28 to 29%, and they successfully scale the technology platform and crypto businesses. If any of those assumptions break, I'd reassess. The way I'd allocate capital here is to start with a half position around 26 to 27, which is where we are now. If the stock pulls back to 24 to 25 before earnings on macro weakness or profit taking, I'd add the other half. If you already own from lower prices like 15-20, I'd hold through earnings and potentially trim 10 to 15% if we spike to 31-32 to lock in gains. The key is not to be all in or all out, but to scale intelligently based on risk reward. For context on how I think about this relative to other names in my coverage, I'd compare the setup here to what we saw with Shopify in 2018-2019, a company growing 30 to 40%, expanding margins, trading at a premium multiple with skeptics calling it overvalued, and institutions quietly accumulating. Shopify went from $150 to $600 over the next 18 months. Not saying this will do that, but the pattern is similar. When you find companies growing this fast with this kind of profitability and this kind of institutional support, you don't try to time the exact bottom. You build a position and hold for the long term. The other thing I want to mention is the THTA ETF, which I think is strategically brilliant. This shows management is thinking 3 to 5 years out, not just quarter to quarter. Asset management businesses have 60-70% EBITDA margins, minimal capital requirements, and create flywheel effects where customers use more products. If I'm a member with checking, savings, personal loans, and crypto, and now I can invest in an ETF paying 12% distributions managed by the same company, why would I ever leave? That's ecosystem lock-in, and it's incredibly valuable. In summary, here's what I'm watching over the next 14 days. First, any insider buying or selling. If we see significant insider purchases, that's bullish. If we see selling beyond standard 10b5-1 plans, that's a yellow flag. Second, options flow. If we see large call buying or put selling, that suggests institutional positioning for upside. Third, peer commentary. If other fintech names like PayPal, Block, or Upstart mention credit concerns or slowing growth in their commentary, that could pressure the stock. Fourth, macro data. If we get weak employment numbers or signs of recession, growth stocks will sell off regardless of fundamentals. My base case is that earnings on January 30th beat expectations, management guides confidently for Q1 and full year 2026, and the stock rallies 12 to 18% into the low 30s within a week. If that happens, I'd take some profits around $32 to $33 and reset for the next quarter. If earnings disappoint or guidance is cautious, I'd expect a 10 to 15% sell-off to 23 to 24, at which point I'd be aggressively adding. The bottom line is that this company is executing extremely well, growing faster than almost any financial in the market, diversifying revenue away from lending toward higher margin businesses, and doing so while generating consistent profitability and expanding EBITDA margins. Institutions are accumulating aggressively, which is the ultimate signal in my work. Valuation is elevated but justified by growth, and catalysts are lined up with earnings in 2 weeks, potential S&P 500 inclusion in Q1, and crypto adoption accelerating through 2026. From my perspective as an equity research analyst who's covered fintech for years, this is a strong buy at current levels for investors with at least a 12-month time horizon who can tolerate 20-30% volatility. Position size appropriately, use options to manage risk if you're comfortable, and focus on the fundamentals rather than day-to-day price action. The market is giving you an opportunity to buy quality growth at a reasonable price heading into a major catalyst event. Take advantage of it. That's my analysis for today. I'll be back early next week with another update as we get closer to earnings. If you want to dig deeper into my models or discuss any of this, drop a comment and I'll respond. Thanks for your time, and remember, in this business, the big money is made by identifying inflection points early, sizing positions intelligently, and having the conviction to hold through volatility. This is one of those situations. See you next time.